I was robbed, I was lied to, I was stolen from.
It will be years and years before I ever get over what's happened.
They were duped. They believed the research, they bought the research, they bought the stocks based on the research.
For the last year and a half, both government regulators and private attorneys have been investigating whether the go-go markets of recent years were steeped not just in excessive speculation, but fraud. Whether investment bankers and brokerage houses concealed conflicts of interest and deliberately manipulated stock prices. Did the biggest names on Wall Street violate the public trust?
Sworn in.
Over a decade, Bernie Ebbers' WorldCom was America's hottest telecom stock. It got as high as $96.75 a share. Now it's worth just pennies. WorldCom was the most costly business scandal in the U.S. history.
You sleep well at night, Mr. Ebbers?
Respectfully decline to answer on the basis of my Fifth Amendment constitutional right.
Corporate fraud. That's the story we know. But the real story behind WorldCom's stunning rise and fall is more sinister. It's a story of pervasive corruption here on Wall Street, how brokers and analysts shaped and hyped the telecom boom, pocketed enormous profits, and then took millions of ordinary investors on a catastrophic ride. $2 trillion in losses on WorldCom and other telecom stocks.
Good day for investors.
Just a couple of years ago, Americans sat mesmerized as the investment bank's stock analysts went on television and touted stock after stock after stock.
AOL, Yahoo, Amazon.
eToys has really created a very strong brand awareness with the
It was Wall Street's version of a telethon.
.com shot up today.
We're on track, it looks like, to hit 1 billion shares today.
Internet stocks drove a powerful surge on Wall Street today.
The dawning of the internet age was transforming Ma Bell's old-fashioned phone network into the backbone for the World Wide Web and the high-tech channel for rivers of data flowing across corporate America. A potential gold mine for Wall Street banks.
What's their role in the whole telecom bubble, the investment banks?
Well, they were really the glue that brought it all together. They were the enablers. If you didn't have Wall Street, you wouldn't have had a bubble because you wouldn't have been able to bring together all the pieces necessary. The hype, the analysis, the credibility, the distribution system, the smarts. It wouldn't have happened.
To most of us, the face of Wall Street is the market gurus.
To look into the future of communication services, you need several assets.
The research analysts keeping score on corporate America.
We rate shares of WorldCom a buy.
Coaching investors on winners and losers.
Important.
I originally thought to myself, gosh, what do I know about stocks and the stock market? So I thought, let me go out to a really reputable brokerage firm that I could trust. And so I picked Salomon Smith Barney.
At Salomon Smith Barney, our research analysts have the resources and determination to find the year's most promising stocks.
Every summer, Salomon Smith Barney's research department reviews the picks of our analysts, including our 36 analysts selected as 1999 Wall Street Journal All-Stars. The result is our 10-plus stock list, the 15 stocks we believe will beat the S&P 500 over the next 12 months.
People are relying on Wall Street to sanction, to give them confidence in what they're investing in. Wall Street is like the seal of approval from Good Housekeeping for a consumer product.
George McKellis runs a family restaurant in Houston. Like millions of others, McKellis put his faith in market analysts. He invested almost $300,000 of his portfolio in telecom stocks to pay for his children's college education, relying on advice from his broker.
He would constantly refer to a guy named Jack Grubman. Never heard of the man before in my life, but he would say, this is Salomon Smith Barney's top analyst. He is the man. This man eats, sleeps, drinks, breathes telecom. And if this man says to buy something, we need to listen to him and we need to buy it.
On Wall Street in the 90s, no one had a nose for telecom like Jack Grubman.
He has generated a pile of cash for Salomon Smith Barney.
Grubman knew telecom from the inside. He'd been a math and marketing whiz at AT&T for 8 years before moving to Wall Street. But Grubman wasn't really doing what George McKellis thought.
The analysts morphed from being the serious, almost nerd-like students of numbers and corporate strategies into being hyper salespeople as an adjunct of the investment banking departments of the firms that employed them.
Analysts like Grubman were not really working for investors. They were the bird dogs for the banks, sniffing out hot new corporate properties. On Wall Street, Grubman personified the New Age analysts, the power brokers who connected companies with banks and banks with corporate decision makers. These close links between stock analysts and Wall Street's corporate clients were the focus of a 2-year investigation by New York Attorney General Eliot Spitzer.
What we found was that analysts were involved from the very beginning of the investment banking relationship, going out there soliciting the client, promising that if you bring your business to our firm, we will take your company, proclaim to the world that it is the best thing since sliced bread, take your company public, keep a strong buy on your stock, and become part of your management team.
Gone was the very idea of independent analysis for ordinary investors.
And the companies say to the analysts, look, we'll choose your employer, but we expect coverage. And what they mean by coverage is they expect that analyst to write favorable research reports about their company. And coverage means we're going to promote the heck out of your stock.
But if that's how an analyst like Grubman worked, where did that leave investors?
It means you're turning your back on one set of clients. That's what he did. That's what the analysts were doing when they played ball just with the investment bankers. It was the ordinary investors who didn't understand the game.
Trust. We are not born with an...
These institutions have been asking us to trust them for a long time.
Trust must be earned. Trust must be proven.
But what has been obscured behind the veil of advertising rhetoric and images is how the nature of their business has changed.
And that is why we measure success one investor at a time.
Jack Grubman and Solomon Smith Barney were essential enablers for WorldCom to take off. It took a rising stock price, it took some very good investment banking and some very good salesmanship in order to sell the marketplace.
And the marketplace for big money was selling institutional investors, pension funds, mutual funds. And in that league, Jack Grubman was the Pied Piper of telecom. Salomon awarded them sweetheart deals so hush-hush that even insiders like former Salomon Smith Barney broker Phil Spartus were kept in the dark. Spartus, who was dismissed and later sued Salomon, used to manage personal stock option accounts for WorldCom's top brass. But one thing puzzled Spartus. He had all the WorldCom executives except Bernie Ebbers. So in August 1999, Spartus called Ebbers' personal financial manager to solicit Ebbers' business and stumbled into a surprising discovery.
He said, well, Bernie already has an account at Smith Barney. And I said, what do you mean? He said, well, he's had an account for over a year in L.A. And I said something to the effect, with who? And he said, with Rick Olson. I said, Rick Olson, who's that? He said, well, he was referred to Bernie by Jack Grubman. He's one of Jack's boys.
What Spartus had discovered was Salomon's exclusive boutique brokerage in Los Angeles, run by Rick Olson and his former deputy, David Chacon, who was forced out after blowing the whistle. Salomon's strategy, Chacon said, was to win telecom banking deals by giving personal windfalls to corporate VIPs, a strategy guided by Jack Grubman and run by a team nicknamed the Telecom Mafia. The crown jewels were shares of hot telecom IPOs, or initial public offerings. Premium clients got huge IPO allocations of new companies on the first day of trading and made a killing.
These shares would rise by 30, 40, 50, 100% the first day. So that in itself is free money. But Salomon took it to another level. Oftentimes, they did not allocate these shares until after the stock had been trading. It allowed the Salomon Smith Barney to buy people, to buy their decisions, to buy their influence, and to buy their business.
By handing them free money.
By handing them free money.
The company reported to Congress that Salomon had handed Bernie Ebbers $11 million through 21 IPOs. But David Chacon recalls hearing from his boss, Rick Olson, who handled Ebbers' accounts, that Ebbers made far more than that from IPOs. Just one example, a company called Rhythms Net Connections, which Salomon took public in an IPO in April 1999.
Well, several days after the stock was trading, I sat right next to Rick. He said, well, between us girls, and what that meant was, that's kind of telecom mafia lingo for this doesn't leave the room. Bernie Ebbers just got 350,000 shares.
Now, are you sure he said 350,000 shares?
I'm sure he said 350,000 shares.
Olson would not talk to Frontline, but Chacon, in a lawsuit disputed by Salomon, said that Salomon gave Bernie Ebbers an immediate kickback of $16 million on that one IPO.
This was a well-orchestrated con game, meaning that here's this group of elite telecom executives that were given preferential treatment in IPOs and loans and other things so that the firm could generate their banking business.
Wall Street, like telecom, was booming. Salomon's profits from WorldCom's investment banking business were huge, but they wanted more. What if Salomon merged with a commercial bank like Citibank, so as one bank, a super bank, they could handle all the needs of a cash cow like WorldCom? If one man understood the potential power of a super bank, it was Sandy Weil. Weil began on Wall Street as a stock runner, and over 50 years made himself the street's dominant banker. Weil was crowned in 2002 as CEO of the Year. His crowning glory was putting together Citigroup, the largest financial institution in the world.
The largest bank, one of the largest securities firms, one of the largest insurance firms being put together under common ownership.
So Sandy Weil and his team can market across the board to Bernie Ebbers. You don't need to go anywhere else, Bernie.
It's a one-stop shop strategy. It's very powerful.
Land records show that these pines belong to a company called Joshua Timberlands, a company controlled by Bernie Ebbers. Ebbers bought nearly 500,000 acres of timberland sprawling across Mississippi, Alabama, and Tennessee in late 1999, thanks to Sandy Weil's Superbank, which arranged the loan and gave Ebbers a $1 billion mortgage.
I think the average investor would like to know, well, is there something here about the relationship between Salomon, or its parent, Citigroup, and the people at this company which should give me pause about how objective they are being?
The whole deal was kept sub rosa because it didn't look good on Wall Street for Ebbers to sell WorldCom stock. So the Superbank devised a scheme to help Ebbers convert his WorldCom wealth into hard assets. Don't sell stock, take a loan.
So here you have Bernie Ebbers getting cash in his pocket by virtue of getting a loan from Travelers to buy this timberland and then turning around and selling part of it for cash.
Timber was just part of Ebbers' private business empire. Luxury yachts, a boat building company, a lumber mill, a ranch in Canada. Not just any ranch, but the biggest ranch in all of Canada, 500,000 acres, financed with a $43 million loan from Citibank. And the Superbank's loan, Coffey says, was backed by 2.3 million shares of Ebbers WorldCom stock.
That's a very troubling link in our view, because Citibank has an interest in the stock price of WorldCom being high enough to cover the loans they've made to Mr. Ebbers. And yet in another part of the same building, you've got Jack Grubman issuing analyst reports saying, buy that stock to drive the price up.
So Ebbers, WorldCom, Grubman, and Weil's Superbank had become so intertwined that the ordinary investor was lost in the trees.
Did you ever attend a board meeting for WorldCom?
Yes.
Is it rather unusual for analysts to attend board meetings?
It is rare, as it has been for me over the years.
Grubman was giving Bernie Ebbers guidance on corporate strategy. For Salomon Smith Barney, the gravy train delivered more than $1.1 billion in investment banking fees from the telecom sector in just 4 years, roughly $140 million from WorldCom.
How much financially you have benefited from working for Salomon Smith Barney.
Big bucks for the banks meant big money for Grubman.
I've been compensated over the past 4 years roughly $20 million per year on average, but that is not tied to any one company.
But to his bosses at Salomon, Grubman justified his huge pay bonuses as rainmaker for the bank, deal by deal, company by company, claiming credit for landing $1 billion in bank fees between 1998 and 2001.
He didn't argue, pay me as an analyst because I'm a good stock picker.
Conflict of interest.
He said, pay me a lot because I bring investment banking revenue to the firm, in essence, by promising those firms that I'm going to push their stocks.
My broker said, look, these people are saying buy these stocks. These stocks are good to buy at this time. And so I trusted him when he told me I was listening to the best and the brightest analyst in the world.
Long-distance prices were plummeting. Telecom hype had produced a glut of overcapacity. Some analysts warned investors to get out.
And we came out with a call that said that the revenues are shrinking and that these companies are not going to be able to cover the cost of servicing their debt.
So you said underperform.
We said underperform, which was sell.
With WorldCom's stock tumbling, Bernie Ebbers was in trouble. The company was desperate for cash. Wiles Superbank came to the rescue. Despite the telecom capacity glut, despite plummeting phone prices, despite Rubin's personal warnings, Citigroup led bank syndicates that sold investors $17 billion of WorldCom bonds. And while Citigroup was limiting its own risk, its star analysts told investors WorldCom's plunging stock was now an incredible bargain.
Good evening. We begin tonight with the most egregious case of corporate corruption.
Then the bombshell, June 2002. Charges of massive corporate fraud from inside WorldCom.
On the brink of bankruptcy.
We're not talking about a few pencils missing from the stock room. We're talking about $9 billion of earnings that were suddenly wiped out. And the investment bankers have an obligation to look for the signs.
Not until April 2002, just weeks before WorldCom was charged with fraud, did Grubman drop his buy rating. And he never did say sell.
What's the fraud that Citigroup and Salomon Smith Barney have been charged with?
The bank recommended a stock when it knew the stock was a bad investment. What was so revealing was this divide between the advice that was rendered publicly, wherein they said buy, strong buy, great stock, great investment, and the internal communications that made it eminently clear that these investments were not worthy.